Good afternoon. Welcome to all of you for the presentation on the annual results of the company. Thank you for making time. We start the presentation with the usual disclaimer on forward-looking statements that we made in the course of this conversation today afternoon. The presentation is in three sections. The first section will talk about the group performance highlights. The second section will talk about the financial results. And the third section will talk about the segmental performance. Starting with the group performance highlights, I think the year 15-16 has been one of the most challenging years for the infrastructure sector and the capital goods industry. There is no doubt about the potential of the country or its economy to get on the growth path. The most important aspect that all of us in the industry and in the government are dealing with are the levers that needs to be moved to make sure that the potential of the country is transformed into viable and sustainable opportunities. While the government and the industry is striving to make these opportunities into viable projects and programs, the company has been focusing on converting the substantial order book that it has into profitable revenues. Possibly this approach is evident from the fact that the company has done better than the previous year in most of the parameters that feature the company's operations. While the decline in the order inflow is reflective of the investment sentiment that prevail in the country and in the industry at the moment, the fact that the company has been growing its revenue by 12% in FY16 or FY15, the fact that it has been able to grow its EBITDA by 10%, the fact that it has been able to increase its profit after tax by 7% is adequate testimony of the fact that the strategy to focus on what is available and within company's control needs to be maximized. Looking at the financial results of the company won orders worth 1,36,000 crores, and that is a 12% reduction over the 1,55,000 crore that we won in the previous year. Through the course of this year, when we set ourselves up, we are looking at a growth of close to 15% over the previous year. But as the years rolled on and the months rolled by, it became apparent that the opportunities that we were targeting were likely to be deferred. Some of them cancelled, but most of them deferred. Consequently, we had to get selective in where we bid for, because it is very important to bid for projects that are viable and that can be executed within cost and time. Consequently, notwithstanding the 43,000 crores worth of orders that we picked up as a company in the Q4 of the year, we ended up the year with 1,36,000 crores. The mix of the orders is 32% international and 68% domestic. And the fact that the domestic markets did not yield to the way that we anticipated in the year ahead is evident by the fact that the share of international orders are a little larger than what it was in the prior year. The order book is at 2,50,000 crore, which is up 7% over the 2,32,000 crore of the previous year. And 28% of this order book is for contracts that needs to be executed in the international markets. The good thing about this order book is it provides the next 3 years revenue visibility for the company without having to battle the task of winning orders to report revenues. Where did these orders come from? There are no prizes for guessing. Much of the investments during 15-16 has happened in the infrastructure sector. So 62% of the orders that we won during the year 15-16 came from infrastructure sector. And this was higher than the 55% share that we reported in the prior year. Hydrocarbon had 7% share, but services, which is included here to complete the story of the portfolio, is about 16%. But pretty much the rest of the sectors have been reflective of the lukewarm investments that have been featuring those sectors. The order book of 2,50,000 has almost 1,87,000 in the infrastructure segment, which means a 75% share of the total order book is in the infrastructure segment. The health of the company, its revenues and profitability going forward depends on how smartly we execute the 1,87,000 crore worth of orders that has been backed by the company. We have 19,000 crores of orders representing the next 2.5 years of execution in power business. We have 15,000 crores of orders in hydrocarbon segment. Metals and minerals, which have been seeing a lot of headwinds, is at 10,000 crore. And heavy engineering business, which also has been suffering the headwinds on account of decline in oil prices and global overcapacity, is at 7,500 crore. The rest of the business constitute 6,800 crores. Getting on to the numbers specifically, the net revenues that the company earned from its operations for the Q4 is at 331 billion rupees. I'm switching over to billions of rupees, which is an 18% growth over the Q4 of the previous year. And for the year as a whole, it is at 1,02,000 crore, which is 12% growth over the revenues of the previous year. It's important to note that 30% of these revenues for Q4 and 32% of these revenues for the full year came from international contracts that are under execution. The increase in the manufacturing and operating costs of the company is reflective of the level of activity and hence is in line with the planned increases. The increase in the staff cost, however, 9% for the quarter as well as 14% for the full year, is reflective of the staff augmentation that we are doing to execute the projects, particularly overseas. The sales administration cost at 16 billion rupees for Q4 and 61 billion rupees for the full year is reflective of the general selling and administrative expenses of the company and the provisioning that the company was required to make for receivables doubtful of recovery. Since these are consolidated financials, these represent all the businesses the company is engaged in. So these provisions representing doubtful debts are across the portfolio, which includes financial services. The company has reported a 10% growth in the EBITDA at 123 billion rupees for the full year. And for the Q4, it is at 48 billion rupees, representing a 35% growth. The EBITDA margins, however, in relation to the revenue growth, is at 12% for the full year, which is a 20 basis points reduction over the 12.2 of the previous year. Being a project company, it doesn't make much meaning out of the quarterly variations in the EBITDA, and this we have been communicating to the markets quite regularly, that the quarterly EBITDAs are misleading for drawing annual conclusions, and annual numbers are better reflective of the trajectory of the profitability of the company's operations. The interest expenses for the year at 30 billion rupees is up 7% for the year, whereas at 7 billion rupees, it is up 65% for Q4. It is important to note that the variation in interest expenses for Q4 is largely on account of commissioning of realty and other developmental projects, which were into execution mode in the previous year and hence facilitated interest capitalization. On being commissioned in the current year, the interests are to be taken to the profit and loss charts, and hence you find a sharper increase in the Q4 interest. The depreciation at 27 billion rupees is up 5%, and apart from the normal increase in the provisions for depreciation, there is also a certain impairment charge that we are carrying in those numbers, representing a toll road that we have surrendered to the government on termination for event of default by the counterparty. After providing for taxes and the minority interest share of profits, the profit after tax for the company for the year is at 50.91 billion rupees, which is up 7% over the 47.65 billion rupees of the previous year. And for the quarter at 24.54 billion rupees, it's up 19% over Q4 of the previous year. The company has 10 segments, and these segments are infrastructure, power, metallurgical and material handling, heavy engineering, electrical and automation, hydrocarbon, developmental projects, IT and technology services, financial services, and the rest. Looking at each of these segments in some detail, infrastructure segment, we have a revenue of 486 billion rupees, which is 12% increase over the 432 billion rupees of the previous year. And for Q4, the revenues of infrastructure segment is up 20% at 180 billion rupees as compared to 150 of the previous year. The share of the international revenues of the infrastructure segment is 145 billion rupees out of the 486 billion rupees, and for the quarter, 48 billion rupees out of the 180 billion rupees. The EBITDA margins for the year from the infrastructure segment is at 11.7%, which is 60 basis points higher than the 11.1% reported in the previous year. For reasons cited earlier, I am not focusing on the quarterly margin variation for this segment. Hydrocarbon segment has commenced its path of recovery. As we've been reporting through the past quarters, the legacy projects are being closed out one after the other, and we are in the final leg of these closeouts. And this fact is evidenced by the fact that the EBITDA margins of this sector, which was negative 1.7%, has turned positive to 2.2% for the year as a whole, in contrast to the minus 15% of the previous year. While achieving these EBITDA margins, the segment reported a revenue of 87 billion rupees, which is 20% higher than the revenue reported in the previous year. And as is the case with this business, which is largely international, the share of international revenue is predominantly higher, 40 billion rupees out of the 87 billion rupees. Moving on to the power segment, the segment earned a revenue of 69 billion rupees, which is up 47% over the previous year. The segment had the benefit of large number of orders that it won in the prior year, and the successful execution of these orders has enabled the revenue to grow at a robust pace. And the robustness is evident both in Q4 revenue growth numbers as well as the full year numbers. We have won some gas power project orders in Bangladesh, and those projects are under execution and well on road, and hence the share of international revenue for the year as a whole is at 18 billion rupees out of the total revenue base of 69 billion rupees. The EBITDA margins at 11.6% reflect the mix of jobs and the margin recognition threshold these jobs are at the reporting date of 31st March 2016. In the prior year, the margins were higher at 16%, largely because of closeout of jobs that was done in the prior year. These were out of the order wins of the earlier years, 12, 13, 13, 14. When it comes to minerals, metals and material handling business, there is considerable headwind being faced by this sector. We know that because of the soft commodity prices and the global slowdown, the demand for minerals and metals have been low. And hence most of the end users who are our customers are on capacity freeze mode. The effort is to make sure that the existing capacities are utilized and profitably sold. Consequently, aided by the tariff corrections that is happening on the import of steel, there has been some improvement in the end clients' revenues and profitability. But since we are in project business, it will take a while for this sector to recover and convert these into investment opportunities. So it is our assessment for the next 1 to 2 years. We may not see substantial investment in the minerals and metals sector. But material handling is a slightly different situation, with the thrust on the mining, improvement on getting the stalled power projects completed, ensuring connectivity, investment in rail. All of this will lead to certain larger exploitation of the mining resources that we have. Consequently, the material handling systems business is expected to do better. The segment earned a revenue of 23 billion rupees in the current year, which is down by 25% as compared to 31 billion rupees of the previous year. The EBITDA margins, consequent to the decline in the order book, as well as under recovery of overheads because of capacity underutilization, is resulted in the year at 5.5%, sharply down from the 10.5% of the prior year. Heavy engineering business has 3 segments. It has process plants, which is hydrocarbon dependent, and we know that ever since the oil prices declined, the investment momentum in the hydrocarbon sector has come down, and there is global excess capacity. Consequently, the fortunes of the process plant business in the hydrocarbon segment has taken a downturn over the last 2 years. We also have nuclear equipments and systems that we supply to the nuclear power industry, and we know that the nuclear power industry, the momentum is yet to be discovered. So consequently, the capacity the company has to deliver for the nuclear segment remains underutilized. We are also in the area of defense and defense equipment, and as we have been noticing over the past many years, the share of defense in the overall portfolio of the company is pretty modest. Given the fact that the government is giving trust and considerable emphasis on private sector participations in defense manufacturing and the Make in India initiative, we do expect going forward the share of defense orders would increase, and that would provide the tailwind for this segment. The heavy engineering segment has reported a revenue of 30 billion rupees for the year, which is 11% lower than the 34 billion reported in the prior year. We also export our equipments and systems to Middle East and Far East, and hence the share of international revenue out of the 30 billion rupees is almost 50%. The EBITDA margins, consequent to certain overruns and cost provisioning for delayed deliveries that we need to provide, is minus 0.7%, sharply down from the 12.3%. We do believe that going forward on executing the jobs that we have on hand within cost, within time, this segment should return back to healthy margins. Electrical and automation business has generally, as an industry, witnessed fairly flattish trend. The industry for the electrical product business grew by 4%, and our portfolio of products also grew likewise by 4%. But the project part of the electrical business has not done well, and this is reflective of the general scenario about the industrial capex and the projects business. So consequently, on a blended basis, the net segment revenue at 46.49 billion rupees reflects a 3% decline over the 47.94 billion rupees. Consequently, the margins from 14.8% of the prior year has declined to 13.9% in the current year. The competition and the price realization, plus the expenses that we have incurred in launching new products, have resulted in compressions of the margin in addition to the business conditions. Developmental projects is a portfolio of infrastructure projects, namely toll roads, metro and ports, as well as power development project. The segment recorded a revenue of 51.37 billion rupees, very similar to the 51.48 billion rupees of the previous year. But it should be noted that the previous year had the gain on divestment of Dhamra port that we did. Consequently, if net of the divestment proceeds, the segment actually recorded a growth of 40%. The growth in revenue is largely driven by the fact that the power plant that we are running in Rajpura, 700 megawatts, had a better PLF in this year, and the demand offtake was higher as compared to the prior year. Also, the fact that the toll roads that have been commissioned, and there are 13 of them, witnessed a 7% growth in traffic, and with no help from the inflation index, which has remained very flat, the growth in revenues was largely driven by the growth in traffic, which is 7%. The EBITDA margins of 41% declining to 26% in the current year is reflective of the gain on divestment of Dhamra port embedded in the previous year's numbers, and hence are not strictly comparable. The financial services business has done well during the year. As you know, we own 68% of the financial services business, which is a listed company. The revenues have grown at 75 billion rupees by 18%, and the profits after tax of the business has grown by 17%, and L&T has a 68% share of the profits. The NPAs have remained fairly stable at 3% of the gross total assets, and the net interest margins have remained steady and stable at about 5.7%. Coming over to the other parts of the services business, namely information technology and technology services, for segmental reasons we are presenting them together, even though they are two independent subsidiaries of the company. The IT and technology services has a revenue of 89 billion rupees, up 18% as compared to the previous year. In terms of dollar terms, the growth has been between 9 and 10%. The EBITDA margins have been higher at 21.6% for the current year, for the year FY16 as compared to the previous year. This is largely driven by the operational excellence, better manpower utilization, and the exchange gains on rupee depreciation. The other segment virtually reflect the balance of the business that we run. Part of it is machinery industrial products business that we run, shipbuilding and reality. All of these segments together do not qualify for independent disclosures and hence are classified as other segment. The revenue earned by this segment is 65 billion rupees, up 5% over the 61 billion rupees. And the EBITDA margins at 20.7% reflect lower realization in the construction and the mining equipment business, compensated by the higher realization in the reality business. Shipbuilding business continues to lose money because of the capacity underutilization. With this, I close the presentation and throw open the floor for questions and answers.
Subramaniam,
Thank you.
I throw open this for any more questions that any of you have, and let's see.
Why is your order inflows?
One at a time.
Mr. Naik, Rachita here from Economic Times. The order inflow has declined and Mr. Shankar Raman explained how the environment is looking. Just to understand the way ahead, what would be the guidance for the next financial year in terms of order growth and revenue, and also are things changing on ground and are things looking any better in terms of order inquiries and orders being finalized?
You see, the infrastructure projects largely depends on government spending. The private sector, as you all know, are going through very stressful time. People who spend on a public-private partnership, whether for airports, whether for ports, or for roads, have all now challenging time. So the 25 to 30% of the order we used to get from private sector no longer is possible now from infrastructure. So the entire burden of expenditure is on government. While there are some movements and possibly there will be accelerated movement in highways building and some expenditure on railways, all the remaining sectors we still need a lots of catching up to do. But we do see now some movement in the sealing project, the coastal roads, and so on. If some of them come and if we can, and Metro 3, then possibly we will have a good opportunity. And I see little better prospects than last year. I think I have been time and again asked, and I always said that though the intentions of the government are very good, the leadership is very good, the implementation is taking longer than we thought. And they are slowly now trickling in, and I hope that within few months they will become more of a visible to all of you to see that there is an increased level of activities. So I think that we have a more confidence now in what will happen over the next 6 to 12 months than possibly 6 months ago. So that is as best as I can explain to you. Also, there are activities on hydrocarbon, there are some activities in power plant. We have improved our competitiveness, so we are exporting quite a bit. You have seen here just now in a presentation that domestic was 68% and international was 32%. We have gradually increased that. Currently, the Middle East is on a very challenging time in terms of spending money on infrastructure and many projects which has been cancelled or deferred. But oil price, as you know, has moved up to $50, so some of the projects may revive and the activities may pick up. On the whole, I think the coming year possibly has some better prospect comparatively than last year.
Can you share the guidance for you?
We still continue to remain very hopeful at about 15%.
For both orders and revenue? For both orders and revenue?
Revenue 12 to 15%. Because of many impediments, you know, I mean, we talked about clearance of land and payment problems, and private sector had a lot of still to, I would say, pay us a lot of money so we don't go ahead and so on. So it will be 12 to 15%, but both are in a way better than this year. Anybody else?
Tonight, reading some media here from ET now. So as you're rightly saying, things are expected to be much more better.
Can you take the mic? Can you take the mic, please? Yeah.
So, as you're rightly pointing out,
No.
Why didn't one of you help?
if I'm audible, as you're rightly pointing out, sir, things are expected to look much more better in FY17. Government has initiated many steps, a lot of reforms have. What is that you feel the government needs to do for increasing the implementation where you see the primary challenges lie? And particularly on the policy side, do you think anything needs to be addressed which is still not been addressed?
Well, I think they need to, for PPP in infrastructure to succeed, they need to improve the hybrid model which they have come up with. I think the investors are still not very excited about it. Second thing is that you need to give a guaranteed return. You remember about 10-12 years ago in power plant we had a guaranteed return of IRR of 16%. You have to come down to that in infrastructure, that anyone who will invest in infrastructure, apart from tax break and many other attractive this thing that they must do, most important is guaranteed return. And it can be done by having an international estimator or a valuer, how much this project should cost, and you can have two of them, take an average of it, and take that as a maximum price that you can pay. Beyond that, his IRR will keep going down if he spends more. Exactly that is what happened in power.
Sir, you mentioned about cancellation of projects. So have you quantified the cancellations in the last financial year, especially in your case?
No,
In Middle East
cancellation
and-
of projects in Middle East, I said, the client is not going ahead. As far as we are concerned, we don't have anything cancelled, but we have a slow-moving project because people don't have money. That 15,000 crore roughly we have already taken out of order book. We'll reinstate that once the financial health for the project improves. So whatever order book you are seeing is discounted by 15,000 crore. Otherwise it would have been
265.
what? 265 instead of 250, right?
That's right.
So this is Promit from Reuters. I understand Middle East is your biggest contributor to your international order book. Is that?
India is the biggest, Middle East is second biggest.
So how much? What is the percentage of that?
20% of the total.
18%, I think, 18-19%.
Okay. So since Middle East, you're saying they're a little slow as of now. So does that mean that to kind of compensate for that, you might have to bid aggressively in the Indian
We are
market?
bidding now in Africa and Far East.
Okay. And
Those were not the territories we had concentrated so much before. So that will make up of any shortfall of our Middle East.
okay. Thanks.
So how confident are you about the defense sector? Because though government is, repeatedly telling that they would want to encourage private sector, but are you happy with the new DPP and how hopeful are you for this?
I think anything could be better than what was before, right? Now, how fast do they move is the only discussion point. They are moving in the right direction. They are encouraging private sector to participate. But there are certain ships which they still keep giving on nomination basis to the to the shipyard, like warships, like many other kinds of survey vessels and the Coast Guard ships and so on. As of today, there are more than 1.5 to 2 lakh crores worth of ships have been ordered or letter of intent placed on public sector, which is not come for competitive bidding to private sector. But all the rest of the item, whether it is submarine, which tender is going to come, or whether it is LPD, which is nothing but helicopter carriers, which is already bidded by private sector, there is nobody from public sector there. So I can say that the activity level is considerably higher in favor of private sector participation than it ever was.
So one question, this is Rahul from Business Line. How bullish are you on Iran? A lot of developments are happening, sport developments. They also want to put up a fertilizer plant.
We have had 4 missions to Iran. Multiple divisional 4 or 5 people went 3 to 4 times, I think 4 times. We already have placed a permanent representative and opened the office in a way in Iran. I think it is still some time because till their oil income stabilizes and come to a point they can meet all their expenditure. Also 140 or 50 billion dollars that they were to receive, which has not come into their bank. I think hardly 20-30 billion has come. So by the time all of that comes, they want short-term loans with whatever project here that you want to do. For 1 year, 2 years, they want financing. India's capacity on EXIM financing to Iran is very limited. So consequently, a big project cannot be done with that unless a specific approval is taken by Finance Ministry. The EXIM keeps on saying you bring the project, we'll go to Finance Ministry, but I think 2 or 3 times we have tried, the movement is slow. So while Iran offers huge potential, I think we have to move little cautiously till we know that financiability is secure.
So this is Bhuma Srivastava this side from Bloomberg. Just wanted to know, you spoke about bidding in Far East Africa. Could you pin down to which countries you're looking at? And secondly, any update on the Infotech IPO? That'd be great.
One thing is in Africa, we are working on 5 East African countries, which is Mozambique, Tunisia, Kenya, Uganda, and Tanzania. Okay? In North Africa, it is Algeria, right? At the moment, these are the 5, but in South, we are likely to now start bidding in Botswana and maybe Zimbabwe, right? In the West Africa, we are yet not looking at it seriously. As far as the IPO of Infotech is concerned, I think it will be about a week before we can say whether we will launch it immediately or maybe a few months later. But the fact that it will be launched.
The last conference, RSR had made a statement saying that, L&D is in a cautiously optimistic mode. Now, NDA has completed 2 years and you have a huge focus in India. So, what is your view now? Are you still on a cautiously optimistic mode or are you upbeat or bullish on the activities?
I would still be saying at the moment cautiously optimistic. Because I told you that situation may look much more clear 4 to 6 months later, when there is a good possibility that all the projects they have talked and they are trying to bring it to active consideration and tendering. If all of that happens, obviously we will convert our outlook from cautiously optimistic to somewhat optimistic.
So this is Shubhra Ranjan from Financial Express. You mentioned that some amount of money is stuck with private companies, which is again an impediment for revenues in the coming years. So could you quantify that? And do you have some money stuck with government also in terms of arbitrations, etc.? And if you'll be able to quantify that as well.
Well, I think it is I can't quantify to you as far as the private sector is concerned. But you know all the groups normally who have a financial stress, right? But all together, I think our outstanding may be from private sector, what, 5,000?
Yeah, could be of that order.
About 5,000.
Could be of that order.
5,000, while from the government, since the orders are much more from government, almost 70%.
About 8,000 crores.
10,000 crore will be from the government. But they are all going to come. It will come slowly, that's all.
So hi, this is Silky from Z Business, and I would appreciate...
From where?
From Z Business. Would appreciate your answer in Hindi. कैपिटल गुड्स का जो नेशनल कैपिटल गुड्स का आज कैबिनेट की तरफ से अप्रूवल हो गया है, तो इस पॉलिसी को किस तरह से आप देखते हैं सेक्टर के लिए, किस तरह से ये चेंज है?
National Capital Goods Policy.
What is that policy?
So it has been approved. I actually don't know the details of it.
You know of any policy?
No, we have not gone through it. I think we'll get back to you on that.
So hi, Shilpa from Bloomberg TV. You had mentioned about how defense, right now is looking, the share is looking modest, but would you be able to quantify going forward in the next fiscal, how much do you see it contributing in terms of either revenues or order book?
See, the order book is pretty large for the company. So for anything to, the order book is pretty large for the company, and for anything to make meaningful impact, the incremental delta has to be significantly large. And that is like, betting big on an area where you don't know yet as to what is the field of play. I think first and foremost, it's important to define the field of play, and which is what the government and industry is trying to work out. So I think your question is maybe 2 years too early.
Alright, thanks. So Shraddha from Bloomberg, Cohen, just wanted to understand if you can share with us anything in terms of the margin trajectory, given the cost overruns that you're seeing in many of your projects, and also the fact that competitive pressures are, likely will remain, will continue to come in this year itself too. So, anything in terms of the direction at least?
I really don't know what it is.
Yeah. See, let me try to address this. The company has reported a margin of about 10.8% for all businesses of the project engineering nature, excluding the services business. So they are very different profile. We do think that the considerable effort that we have taken in rationalizing our portfolio, bringing in automation, operationalizing excellent SOPs, all of that should provide us levers to counter the headwind in terms of competitive pressures and limited opportunities and a lot of capacity chasing. So our own assessment is from where we are today, from a limited perspective of, let's say, next 12 months, we do see a 50 basis points improvement as a result of all of this happening. The trend is upwards. In best of times, we used to report 13.5% margin. And we've been maintaining that to stay at that level, the conditions will have to stay stable, which was not the case. So we've come down to something like 10.8 from 13.5. So the range really available for good times and bad times is between 10 and 13.
So hi, this is Hamsi from Business Standard. Another question on margins. After a very long period, we've seen margins improve.
Can you stand up? I can't even figure out. Yeah, okay.
After a very long time, we've seen margins, your blended margin go up to 14%, 14.5%. Is it sustainable? And what is your outlook for this quarter, for Q4? And what is your outlook for the full year next year? And B, you've taken a 15,000 crore write-off on your orders. Can we expect more of it in FY17?
Not write-off. It has been removed temporarily until they get active again. They are not cancelled orders. So they are not write-off, number one. To give more reliable information to people at large and investor, we give a very correct statement. I mean, we need not have removed it because they are not cancelled. But we have removed because all practical purpose we are unable to go ahead and work on it. Maybe a year later they will all come back.
So it's just a one-off this quarter?
No, I'm saying currently whatever were slow moving we have removed. Right? So there is nothing more slow moving at the moment. But 6 months later, if we find that out of 15, 5,000 has started moving, we'll bring it back. And it will happen, it may happen that 10,000 crore may become slow moving. Right? So we'll keep it aside. So it's a dynamic situation. All that you should know, important is that order book that we show is an active order book. Does not contain anything which we cannot work on.
And insofar as the margins is concerned, I did mention to you that quarterly margins are not necessarily reflective of the portfolio on a longer period. We are in project business, it takes 3 years on an average to execute. So while ideally it should be over a 3-year time frame, the patience of the street is much shorter than that. But neither can we come down to 90 days. So our belief is that when we talk about 10.8% improving by another 50 basis points, is for a period for a year. Depends on which project comes for valuation, which quarter. And these are not margin declaration-led completion. These happen on its natural course, and margins are a consequence of that.
Sir, in one of your recent interviews to Fortune magazine, you said that Mr. Subramaniam will take over the responsibility of Chief Executive. And when is it going to happen, and what will be the roles of your role and Mr. Subramaniam's role after that?
Well, so far as, let me tell you what I said. Who after you? That is a question which has been asked for years together, right? And this time I said, since Mr. Subramaniam is appointed as a Deputy Managing Director and President, and he is the only one at that level, I said anybody visibly can see he is the number 2, right? I don't see anybody else coming from outside to be able to run this company. So I said to Fortune that you can surmise from that he has a pretty good chance to be the next one. Now, whichever way they may have written to excite you, it is another matter. And by the way, it may happen next year sometime before September. That also I mentioned to him. I think he has written. Yeah.
Good evening, Mr. Nayak. I'm Rajesh Gajurao from Financial Chronicle. Just wanted to understand, you mentioned about guaranteed returns in the PPP infra projects. Now, just I wanted to understand a little bit about more what you mean by that. Because there is a sense that it might be counterintuitive, asking for a guarantee.
No, let me put it this way. Take any project, Project A competent authorities who know the subject very well, and there are many in the world who does nothing but project appraisal, estimating and proposal. So suppose they were to say this project which you have, the project which you have come to the bidding for must cost 8,000 crore. Let's say they gave an estimate of 8,000, right? And then you go to appraiser 2. He said, no, this is 7,500. You take both and you take average of 7,750, right? Now you can bid up to 7,750. You are willing to give a return of 16%. If your estimate is 9,000 crore, instead of that, and you bid 9,000, and if you happen to get the job, mostly you won't get because it is beyond the limit. But suppose everyone quotes high and you get, then your IRR will drop from 16 to maybe 13.5 or 14. This is what it means. If the competition is very severe and you quote 7,000 crore instead of 750, right? Your IRR will still be 16. You won't get for 7,750. That is the ultimate limit at which you can get 16. Beyond that, IRR will keep coming down. That is what was done by the power sector, where they had gone by 5,000 crore per 5 crore a megawatt was the limit fix, and that they time to time revise it. That means you can get that IRR of 16% up to 5, but not beyond. Now you can say then everyone will quote 7,750. No, because somebody will quote low and take it.
This has to be seen in the context of the environment we operate in. Today, capital is very shy to take all these kind of risks. Now, how do you induce them? What Mr. Nayak possibly is mentioning is this is one way to get them onto the table. This need not be a permanent solution.
Well, power was not a permanent solution. They withdrew afterwards.
Absolutely.
Thanks, sir.
Thank you.